So, hi everybody, this is Hustle Hub. I'm Giacomo, and today I'm again with Darcy Norton. He published another article on Seeking Alpha. He talked about Crombie Reit, and today he's going to talk about this Reit with us. He made a presentation. So, Darcy, for those who don't know you yet, please introduce yourself, and then we'll jump into the presentation.
Hi, Giacomo. Thanks for that introduction there. Glad to be back. So today I'm covering Crombie Reit. They are Canada's only REIT with over 50% exposure to grocery stores. They are essentially in a partnership with Empire being the parent company, and Crombie operating underneath them. Empire owns about 43% of the outstanding float. So if you want to, so here we have the trading data for Crombie Reit. And as you can see, they trade on the TSX under CRR.UN.TO. And for Canadian investors, I've noticed that on different brokers, that ticker could be a little bit different. Sometimes the UN won't be there, and sometimes the TO won't be there, especially for Bank of Nova Scotia, that brokerage right there. So just be careful. In the United States, it trades on the over-the-counter market under CROMF. It's got a market cap of roughly 3.25 billion, enterprise value of about 5.4 billion, and it pays a monthly dividend of about 7.5 cents, right, which works out to about 89 cents a year, and a yield of about 4 to 5% depending on the trading range. And the average analyst expectation for their price is about $19 to $20.25. And we'll touch on a lot of this later in the article, but for those of you who are looking to do a little bit of active trading, if you want to take a screenshot of this screen, just to get your average data, you're welcome to do so. So next, I just want to talk about why I originally got interested in Crombie Reit. And for full disclosure, when I was doing my master's degree, I had the opportunity to sit down and have a quick little lunch with the CEO of Crombie, Don Clow. And that's how I originally discovered Crombie. And then it was kind of funny because later that day, the dean of my program, he started talking about Crombie Reit and how excellently they were run. So I got to take a deep dive into their management and have a little case study when I was doing my master's. And the first thing that stood out to me was that they have a very strong distribution history. So they've been paying that dividend that I was talking about at the same consistent level since May or April of 2008. And they've managed to keep it the same ever since. They have had a special dividend, but that was only once, and I don't think that will be coming back anytime soon. They've also had a very strong total return. So since they IPO'd in about 2006, they've had a total return of about 400%. The TSX has had a total return of about 175, 180%. And they've also outperformed the TSX capped REIT index, which I don't have the number off the top of my head, but if I'm remembering correctly, it's about 267%, 265%. Fact check me on that just because I don't have the numbers in front of me. But in recent times, I got interested in Crombie again as the demand for real assets and the demand for those selling real assets has increased. And Crombie is pretty uniquely situated as they have such a great exposure and great cooperation with grocery stores. And so by owning these stores, they should see increased demand from investors for their assets. And the tenants that they have who are selling real assets and who are selling real services will also see increased demand, as a lot of their tenants have consumer staples and cheap consumer goods that doesn't matter the economic environment, even if things really kind of go as bad as they can within reason, people will have to buy these goods. These are basic goods such as hygiene, food, that type, and government services and banking services. So people need access to their money, people need access to food, They need access to hygiene to live. And then on top of this, they've managed the pandemic fairly well, but they suffered a credit downgrade from a BB stable to a BB low. And they've been managing their credit fairly well, and they're looking to get their credit upgraded back to where they were, and maybe even slightly above, but we'll touch more on this in a little bit. So I want to get into their assets. And so if you look at the right here, you can see that about 85% of their assets are in retail related activities. So this would be grocery stores, this would be in low-cost retailers such as Giant Tiger and Dollarama. For those of you who aren't familiar with the Canadian market, these are very low cost. It'd be something I can't remember the name, and I won't get into that. But they're very focused. About 10% is in retail-related industry, and 5% is in office. And then if you look at the right, you can get a deeper look at where they are focusing. But I think the best way to view this is if you go and look at their largest tenants. So you can see about 57% of their tenants, their rents come from Empire. So that's almost entirely grocery stores. Then you have Shoppers Drug Mart at 2.6%. They're a pharmacy chain. And then Province of Nova Scotia, Dollarama, and Bank of Nova Scotia. And so all these tenants you see here are all very strong, very fundamental to the Canadian economy. And out of every single organization I see here, there's only 3 that really raise a concern for me. And those 3 would be Good Life Fitness, Cineplex, and Staples. And the reason is that in the last 10, 15 years, every one of those has had some type of credit issue. But when you add all 3 of those together, they're less than 2.5% of the rent exposure. So if all 3 of those would default at the same time and refuse to pay rents, Crombie's still not going to struggle too much. And through the entire pandemic, they never dropped below 99% of rents collected, or perhaps that was 98%. I believe it's 98% actually. So I think that they are doing very well with their tenants. They're seeing very high demand for their assets. And so NAV should continue to increase because of this. And this is going to be a good flight to safety for many investors, and it's been flying under the radar for a long time. So next, I want to take a quick look at the credit. Well, a quick look might not be the right words. So back in June of 2021, Morningstar DBRS, they downgraded Crombie from a BBB stable to a BBB low. They did this because the debt to EBITDA ratio reached 10.5 times. And they had predicted that by year end of 2021, it'd be 10.7. And then in 2022, be a 9.7. And back at the end of 2020, the 9.7 is where they were. And so they were predicting that they would have a little bit of credit difficulty. But Crombie really, really responded. And so what they did is that by the end of Q4, they had EBITDA down to 8.2, debt to EBITDA down to 8.25 times, and EBITDA coverage to 3.13. And as you can see on the screen, this is around where Morningstar wanted them to be to consider a credit upgrade. And I don't believe they'll go much more than a BBB. I don't actually believe they'll leave a BBB because they have so much exposure to Empire, who's only a BBB low. But at the same time, they should see a little bit of interest savings. And as the interest rates rise, this is even more important, as when you look here at this next screen, you can see that that their most difficult to roll notes, they're senior unsecured. They're rolling this November. So if they manage to get those out, then all they have is their mortgages to roll. And as those are collateralized, they're much easier to roll. And you can typically, you can typically get a slightly less of a mortgage rate because they're safer. And they've also been targeting these mortgages because they're looking to unencumber their assets, their balance sheet, to increase their financial flexibility. So over the next 2 years, 3 years, they're looking at a greatly expanded flexibility in their balance sheet. They're going to be rapidly paying down these mortgages if things stay on track. And in 2021, they managed to pay off $200 million of these mortgages. And they're always looking to pay off their high interest debt first. So I think this is a fairly bullish development. However, at the same time, you are going to see a little bit of expanded costs as these roll over in the next years. And I'll talk about that a little bit more when I talk about their risks. So I then did a valuation. I did do a perpetuity model. I did do a discounted cash flow models, but I don't really see those being as effective as a way of evaluating a REIT as the NAV model. So for those of you who aren't familiar, a NAV is basically the net asset value of the company. I got a value of about $19.80. This is roughly around what the analysts have the company as well. The company is trading around $1 under that, $1.50 under that. And I think this is kind of a lag because of the current difficulties with the rising cost of interests. And but I do think that as the year goes on and people continue to see different economic stress and market stress, that companies such as Crombie will continue to benefit, and they'll trade closer and closer to their NAV. So I just want to do a quick recap of what risks they might have. So I really thought of 2 risks that are their main risks. So the first would be their tenant defaults. So they have quite a few tenants. Sorry, not quite a few. They have a few tenants that if they defaulted in economic hard times, and this would kind of ruin their perfect record of having almost 100% rents collected. And so if this happened, then you might see a little bit of a falter. And at the same time, if this happened and you had rising interest rates, then you might see you might see some difficulties, as Crombie expects that if interest rates rise by 0.5%, they'll see $400 million in additional interest expenses. So interest rates are expected to go up around 2% this year. So that's about a $1.6 billion additional expense. So I would love to see Crombie pay down their fixed rate debts and variable debts even quicker, or at least put some swaps on their variable rate debts, which they have done for about 100 million of them. But this could prove to be pretty difficult, and they don't have an infinite balance sheet to pay off all these debts. So I see these being the only substantial risks at this time. So Giacomo, if you have any questions, I'd love to hear them.
Could you go back to the slide where you had all the clients of Crombie?
Yep.
So, okay, what are in his list? What do you see as the ones that could get hurt? What are the clients over here that you see that could get more hurt from a interest rate rise?
Okay, so the ones I could see getting hurt the most, I see Staples. So Staples, they sell office equipment. I believe they've been restructured at least once over the past 5 years, and they're not doing very well. Anyways, so that's one of them. There's Cineplex. They're a movie chain, and they've obviously had a very hard time in the pandemic. And then there's Good Life Fitness, and they're a gym brand. And I remember reading a couple articles, it would have been years ago now, but how they are loading on debt. And they're also not credit rated. And so those things are a little bit concerning to me.
Okay.
So those are the ones I see being the most vulnerable to interest rate rises. Most of the other ones are pretty much staples in the Canadian economy.
Okay. And as a result of the increasing interest rates, can you see the company struggling and maybe getting rating, having their rating lowered, their credit rating lowered as a result of that because of the interest rate rise? So therefore, they have to pay more in interest rates.
I think they're planning on like they forecast these rates and they've seen them coming. They put a lot of emphasis on them the last 2 years. Sorry, not 2 years, but the last years. I do see it as a risk though, and I think they're really trying to deal with that now. But I'm really hoping they get ahead of it. But I do see that as a pretty substantial risk. Yes.
Okay. The last question that I have is, given the fact that I see a lot of banks as their clients, for example, I come from a country where banks used to have a lot of branches. Italy, for example, has one of the highest ratings, highest percentages of bank branches for every 1,000 citizens living in a certain area. Is it how is the situation in Canada from that standpoint? Because in my country, for example, banks are closing branches every day almost, because the digitalization of services are making branches less useful. Therefore, they're just a cost and they're closing down a lot. Is it a possibility that digitalization would make the banks close more branches in the future in Canada?
So that is currently happening in Canada. I used to work at RBC, and what they would tell us there is that they're expecting to close down many of their branches. So if you had 2 branches within a certain radius, expect one of them to be closed, and they're going to consolidate the employees together. So that is a risk. But at the same time, a lot of the assets they have here are kind of considered to be a cornerstone or like in very desirable locations. So the way that I've read on the different M&As of the different banks and when I worked at RBC is that they're looking to close kind of their secondary locations, so the ones on the streets that aren't on Main Street. And a lot of these streets are a lot of these locations would be on a main street or they're in a high traffic area. And they're always going to be high traffic areas because people always need to be going to these places. They always need to be going to their food. So I see that as less of a risk, but that's an excellent question.
Okay. Are they diversifying in the kind of real estate they have, maybe more logistical warehouses or something like that, or they're sticking to what they know and mainly they'll stick to retail?
Oh, sorry, I forgot to mention that. So actually something that they're doing and how they managed to deleverage their balance sheet so much is they've been selling a lot of those warehouses and related industrials. So they've been selling a lot of those off and really focusing just on their retail focus. So they've actually stopped being so diversified and they're really trying to focus in on the retail.
Okay. So I'm done with the questions. If you have anything else you want to add, you're free to do so. If not, I really want to thank you for your contribution and for the insights that you shared with us today, Darcy. So thank you a lot.
Thank you, Giacomo. I appreciate the opportunity to share my ideas. Thank you.
Okay, so this is it for today. I'm Giacomo. This is Hustle Hub. See you next time.